Alright, folks, so now we have before us Chapter 6, which happens to be a very dense chapter compared with some of the other stuff that we've gone over. Partially in view of the fact that in a lot of the other chapters I've weeded out some of the stuff that has gone away because of the reform. But all of this stuff is pretty much still the same. So we need to really cover the whole chapter and examine every single section. The first part is relatively basic. It's just talking about the basics of a Schedule C. So we talked about a Schedule A last week, which is your itemized deductions. We've already talked about a Schedule B, which was your interest and dividends. We've seen that on one of the other returns that we did on the walkthroughs. But Schedule C is where you actually are self-employed. You have your own business. Often if you're paid as a 1099 contractor, if you get a job and they say, oh, well, you're not going to be an employee, we're going to treat you like a contractor. A lot of times their employers aren't supposed to do that, depending on how the job is set up. Normally, if you're a contractor, you go at your own leisure, you control all the workflows. You don't really have a set schedule. Stuff like that. So, but if you do actually contract and you have a large degree of discretion and you have multiple clients that you work on, you are truly self-employed, and you'll likely get 1099s from multiple people, not just from one business. If you have one business that you're servicing and that's it, then you have to look at that very carefully. Okay, so the Schedule C is basically a tax basis income statement. That's really all it is. And you should have already looked at income statements in your intro to accounting classes. Oh no, what the hell is that? So on the Schedule C, they're going to show your taxable receipts minus your business expenses. And this again is just stuff that has to do with the business, like your business income. So it wouldn't include interest or anything like that. And then any deductible expenses. And so the net of those two things is going to give you a profit, or it's going to give you a loss. And that's it. That's all there is to it. So you can look at that schedule in your book. They have a picture of it. You can also Google the latest version of it. Just make sure you're clicking on irs.gov link and not some weird link that might be a hacking site. But yeah, either whether you look at it in the book or if you want to see the 2017 version, 2018 version, you can Google for that. I think the 2018 might be out now. I'm not sure. So I won't stop here. They also have the 1099 miscellaneous form for you to look at. So that's if you're getting paid as a contractor, that's what the business will furnish to you. And what they're doing there is they're reporting what they paid to you to the federal government. And so if you don't report that income, the government's going to come looking for you. So a lot of businesses won't be, because they want to get the tax benefit of paying you. They're not going to want to just pay you under the table in cash. So you can just say, oh, look, never happened. And so they want the tax deduction, so they furnish your 1099, and then that tells the government to look for the income on your tax return. Oh, shoot. All right, I see they're going through the cost of goods sold. I'm not going to go over that because that to me is just a review of your accounting class. So I'm going to skip over. Let's talk a little bit about the expenses that are deductible in your trade or business. So something ordinary and necessary for the trade. An example of what that would not be. You'll notice if you look at the Schedule C, if you look at all of the line items, there's nowhere that it says charity. Okay, so if you have, if you are as a business are making charitable contributions and you're doing it as if your business is donating it, well, you really don't report those on your Schedule C as an expense. You're going to report those on the Schedule A. A similar thing happens if you're a partner in a partnership. If you are a shareholder in an S corporation, so those are flow-through entities where the income flows through to you, but you're sharing the entity with multiple people, whereas with your own business as a sole proprietorship, that's what the Schedule C is basically reporting, sole proprietorship income. As a sole proprietor, all the income flows through to you, but you're not sharing the entity with anybody. It's basically you and the entity are the same. So you report charity on Schedule A. Same thing happens with the partnership or an S corp. All of the charity is going to be reported to you, your share of it, and then you'll report that on your Schedule A. The only entity that will actually report charity as a business expense is a C corp. Okay, and they are a tax-paying entity. The other business entities don't pay tax in general. So sole proprietorship. Any charity that's not ordinary and necessary to the trade or business. You don't need to donate to charity to keep the lights running, to keep your utilities paid, at least not directly. Obviously, there are some long-term benefits to investing in the community, but it's not a direct benefit to keep the lights on. So ordinary and necessary. Utilities, the cost of whatever product you're selling. If you have vehicles that you're utilizing in the business, certain deductions can be taken on those vehicles. Let's see. Rent for an office. They've even got a home office deduction. If you don't have an office outside of your home, if you do all of your administrative work inside of your home, and you've got a designated area of your home that's for that, then you've got home office expenses you can deduct. Let's talk about some things that don't qualify. So anything that's in general against public policy. In your book, they mention illegal stuff like bribes, kickbacks. Those are corrupt practices, basically. And then political stuff, also not deductible. Anything political, that includes lobbying. And then fines or penalties. Like if you get a ticket, that is not a deductible expense because you have violated the law by getting that ticket for speeding or running a red light or whatever you did. So the government's not going to let you take that even if you incurred that penalty in the course of business, like while you were running an errand or something, visiting a client, you got a ticket. It's against public policy, so it's not deductible. There are some exceptions if you're a drug dealer. So remember, that's one of the ways they got Al Capone. Al Capone, all of his illegal operations, they could never catch him, but then basically what they did is they went and made illegal activities taxable, and they were able to go after him for tax evasion, for not paying his taxes. So for that reason, illegal activities are taxable, and they let you deduct certain expenses in the course of carrying out illegal activities, such as prostitution, if it's not legal in that particular jurisdiction, illegal drugs, stuff like that. So let's go back and look at some of the problems in the back of the chapter before we cut it off. I think this is probably after we do a couple of examples here. We'll cut off and then start a new video for depreciation, because depreciation is kind of a strange topic. Strange, very strange. Alright, I am looking in the problems. Some of these may be in your homework. I can't remember which ones are. But we'll just take a look at number 37. So Kelly is a self-employed tax attorney whose practice primarily involves tax planning. During the year, she attended a 3-day seminar regarding new changes to the tax law. She incurred the following expenses. Okay, so this has to do with travel. And basically the only thing we have to worry about with travel is if she was also doing personal stuff. Okay, if she said, oh, while I'm here, I'm going to, bring my whole family along, and we're going to take, 5 extra days after the conference is over to see stuff. Okay, some of that, and we'll talk about that later in this chapter in another section of the video, but those things can have an impact on how much of the travel is deductible. In this one, it doesn't mention any of that, so we're just going to assume it's all deductible, except for one thing that we have to pay attention to are the meals. Okay, because of the historical abuse with meals, and also along with the fact that you have to eat anyway, even though you're maybe eating while you're working, they have a cutback adjustment. So they basically limit the deductibility of meals to 50%. Now, before the tax reform, it was called meals and entertainment. So you could go out to a meal, but you could also entertain. Like, you could go out to baseball games and stuff, with clients, all kinds of stuff, and that would be called entertainment. But that, as a part of the 2018 tax reform, is gone away. So now it can only be meals. It can't be like any extravagant entertainment. So you have to very, very, very carefully look at, okay, is this a meal? Is this entertainment? Okay, obviously, if you're going out and just chugging beer all night with a client, that's going to be more like on the long lines of entertainment, even though beer is like liquid bread, according to some. But that is not going to be, probably the IRS would look at that and say, this doesn't look like you ate anything here. And we don't consider beer. I don't think the IRS considers beer food. So there. So only 50% of meals are deductible. So in this particular question, we would take all of the lodging, $400. We would take half of the meals, which amounts to, oh shoot, they've got a decimal on there, that sucks. So depending on how the book tells you to round, or how Connect tells you to round, I guess that's going to be $47.50. And then the registration for the course. And the transportation. We add all that up, and I get $750, $900. I get $947.50. So unless I have a math mistake, you might add that up on your calculator to see if I'm making a stupid math mistake, because that does happen to me from time to time. I do make math mistakes, and that's okay. Kelly, and then in part B, so that's part A. In part B, it says Kelly believes that obtaining a CPA license would improve her skills as a tax attorney. She enrolls part-time student in a local college to make blah 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 blah. She spends $1,500 for tuition and $300 for books. Now for that, that's going to qualify her for a new type of job. Okay, so as a tax attorney, she can do a lot of stuff, but a CPA is actually going to afford her and give her a credential to do other things. It's going to open up new doors, apart from just legal tax consulting. That was not going to work. The only way she could make the $1,500 work is that would be a tuition and fees deduction that we talked about in the adjustments chapter. I believe that may have been chapter 4. I believe chapter 4. We talked about adjustments. Then she could also make that work probably under the lifetime learning credit, which we will talk about later on. But because that particular education expense qualifies her for something new as a business expense, or as another education expense like under itemized deductions, which don't apply anymore, it would not work. So these are her only two options if she wants to benefit from the expenditure for that particular course or for that particular college education. Alright, number 38 is kind of similar in the back of the book. But again, you've got meals, you've got gratuities, so you'd have to cut those in half. Now, as far as the party for the employees, that would be fully deductible because it benefits over half of the employees. So that would be fine. Okay. Alright, nice. So I believe that I am going to stop this video and upload it, and then we will move on to the second segment talking about depreciation.